Now, this story is kind of personal to me because I know these guys. Townstone. Townstone is a brokerage out of Chicago, and they settled a lawsuit with the CFPB on what the CFPB calls modern-day redlining. Not just redlining, but modern-day redlining. Now, in case you don't know what modern-day redlining is, it's this.
See, in the 1930s, as part of the New Deal, FDR created loan programs to help Americans finance their homes. But to decide who got those loans, the government created color-coded maps in which green neighborhoods were good and red neighborhoods were bad. This practice became known as redlining. Because of these policies, if you lived in the green neighborhoods, it was super easy to get a home loan.
All right, I can buy property.
But for folks in the red areas, no loans were available.
It is a discrimination that people of color face in accessing financial products, banking, and loans. It can take many forms, including
higher cost financial products, limited access to credit, and reverse redlining. This is when certain geographic areas are targeted for credit on unfair terms. For example, during the subprime mortgage crisis, Black and Hispanic borrowers were targeted for subprime loans even when they qualified for prime mortgages.
Okay, and let's be very, very clear about this up front. Discrimination in any form sucks. It's terrible. It should be punished, and I'm glad that we have groups that enforce it. Okay, so let me explain. Townstone, these are a group of middle-aged loan officers who have a radio show on the weekend, just like we have here with KNBR, you know, the sports radio show, and you go there on a Saturday or Sunday, and then, of course, you get broadcasting that's not your regular stuff. So you know how this goes. On the weekend, you get that financial planner guy, and then you have that loan guy who has a show on a Saturday or a Sunday. It's generally pre-recorded, and the lender is paying for that spot on that station, access to that database. So that's what these guys are doing. They're a bunch of loan guys who like sports. Does that sound familiar? And when you get my age, you like to talk about the past, your childhood, those great years that are on the other side of the mountain, not the downward one we're on right now. Now, when they were growing up, they had a corner grocery store where they all grew up. This corner grocery store has like boxes and piles of stuff absolutely everywhere. You know, produce all piled up over here, drinks over there. I mean, you know what I'm talking about, right? And as kids, they called this place the jungle because as a kid, it looked like a jungle to them. It was common vernacular in this area of Chicago. So while talking shop about their childhood on the radio show for loans, they referred to this grocery store as the jungle. Well, the CFPB caught wind of that, looked at the demographic of the neighborhood where the grocery store is located, and they chose to assume that there was some type of prejudicial bias going on. Bam, they're getting sued. They're not talking about people. They are talking about a grocery store than a term that everybody used. Now, I can tell you, I know these guys. They were simply reminiscing on their childhood as I do. There was nothing inferred that could be deemed prejudicial. Yet that's what modern-day redlining is according to the CFPB. So answer me this. The story I just told you, is that modern-day redlining? In case you forgot, here it is again.
Higher cost financial products.
Well, it's not that.
Limited access to credit.
It's not that either.
Or reverse redlining. This is when certain geographic areas are targeted for credit on unfair terms. For example, during the subprime mortgage crisis, Black and Hispanic borrowers were targeted for subprime loans, even when they qualified for prime mortgages.
And it's not that, yet they settled. Now, do you want to know what does, in fact, fall under modern-day redlining as far as I can tell? Fannie Mae and Freddie Mac's loan level price adjustments. It goes like this. The lower your scores, combined with a higher loan-to-value on your property, the more you're going to have to pay to get that interest rate on that loan. And we know, according to the Census Bureau, that Hispanic and African Americans have lower credit scores and lower amounts in savings, which means a disproportionate number of African Americans and Hispanics are going to find themselves being charged more, not by that loan officer, but by Fannie Mae and Freddie Mac. That's a very clear case of redlining because you will have a disparate outcome based on the matrix that was put together. I mean, go check it yourself. That limit can limit your access to credit. Check. And it certainly targets certain geographic areas. Check. Like where that grocery store is located in the settled Townstone modern-day redlining case. So my thinking is this. Sue Fannie Mae and sue Freddie Mac. because they're the ones, in fact, guilty of what Townstone has just settled. And settled because, well, I mean, let's put it this way. If the Fed wants a settlement, the Fed's going to get a settlement. In the meantime, be conscious and conscientious about servicing everybody in your community. As hard as it might be with these prices, and as hard as it might be with some of these loan level price adjustments, because we as loan officers could be proud of serving and servicing everybody, regardless, in our communities. Thanks a lot. Hey guys, Brian Stevens here with Mortgage Shots. Listen, next Wednesday at 11 o'clock Pacific Standard Time, I'm going to be hosting a webinar on best next practices, how the market has changed, and we self-source everything. We don't listen or ride the tailcoats of anybody else, and all of our stuff works. So check it out next Wednesday. Fill out the information down below.